Few events in recent history have shaken the global economy as much as the financial crisis of 2007 to 2008. What started with the collapse of the U.S. housing market quickly spread, devastating markets, destroying fortunes, and causing massive unemployment. But what many still fail to grasp is that this crisis was far more than a mere failure of the financial system. It was a true wake-up call for the world. How did we reach a point where major banks needed bailouts, while millions of ordinary people lost everything? And more importantly, have we learned the lessons necessary to prevent this from happening again? The extraordinary impact of this crisis continues to echo through global markets. The roots of the U.S. housing market collapse, the global financial crisis of 2007 to 2008 began to take shape through a mix of extraordinary factors, most notably the collapse of the U.S. housing market. In the early 2000s, the American housing market appeared promising and innovative, driven by an almost irresistible curiosity about home ownership. Houses were viewed as safe investments, and many people believed that prices would keep rising indefinitely. This fueled rampant speculation. Financial institutions encouraged lending, even to people without solid financial histories. Banks created high-risk mortgage packages, subprime mortgages, to meet the growing demand, assuming that the market would keep expanding. As a result, many people bought homes beyond their means, trusting that rising property values would be their saving grace. As banks continued creating more and more of these high-risk mortgage-backed securities, the nature of the market began to change dramatically. Mortgages were bundled into financial products and sold as if they were stable investments. This created an illusion of safety for investors. Behind the curtain of numbers and guarantees, the market was being fed by an increasingly unsustainable structure of risk. The curiosity about high returns masked warning signs. Financial regulators did not bother to dig deeper into the complexity of these products, trusting the market to resolve everything on its own. Eventually, the housing bubble burst, and the nature of financial phenomena began to unravel tragically. When interest rates rose, many homeowners realized they could no longer afford their mortgages, leading to a massive spike in defaults. Homes, once a symbol of stability, became a financial trap for millions of Americans. This domino effect was first felt in the real estate sector, but quickly spread to other areas of the economy. The public's curiosity about how everything collapsed would soon be replaced by panic. This sequence of events directly impacted banks. The mortgage-backed securities that were scattered across the global financial system began losing value rapidly. What had been seen as a safe investment became one of the biggest enigmas of the crisis. The mystery of how such influential assets could lose value so quickly and devastatingly left many economists perplexed. Financial institutions worldwide discovered they were exposed to risks they hadn't fully understood. Major banks began suffering unimaginable losses. The U.S. housing market collapse not only destroyed families who lost their homes, but also shook the foundations of the global financial system. Major financial institutions like Lehman Brothers were deeply involved in the subprime mortgage market, and the collapse of one such institution in September 2008 was a shock to the world. The interconnectedness of global markets became clear in an extraordinary way, showing that a crisis that began in the U.S. could quickly spread around the world. The intertwined nature of the global financial system turned the housing collapse into a worldwide recession of historic proportions. The early stages of the 2007 to 2008 financial crisis revealed to the world that, in such a complex and interconnected system, the collapse of a single sector could bring down the entire structure. Public curiosity about how economies could be so vulnerable to these phenomena began to grow. The housing collapse was only the starting point for a series of consequences that would shake governments, companies, and families worldwide. The explosion of subprime mortgages and systemic risk, the expansion of subprime mortgages, was a central factor in the 2007 to 2008 financial crisis, and their explosion revealed how quickly systemic risk could spread. Subprime mortgages were offered to people with poor credit histories, who wouldn't typically qualify for traditional loans. However, in a climate of optimism and greed, Banks and financial institutions continued granting these loans in a reckless manner. The public's curiosity about the high profitability of these mortgages masked the fact that they carried extraordinary risk. The financial system seemed oblivious to the danger, driven by the false belief that property values would keep rising forever. The real problem with subprime mortgages lay in how banks handled them. These loans were not kept as individual debts. Instead, they were packaged and sold as securities in the financial market. These bundles, known as mortgage-backed securities, were mixed with lower-risk mortgages, creating the illusion of a safe investment. Institutions worldwide began investing heavily in these securities, often without understanding the complexity and nature of the risk they were taking on. The phenomenon was clear. Risk was no longer isolated to the banks issuing the loans, but was spreading throughout the global financial system. As the housing market began to falter, it became evident that many subprime borrowers would not be able to repay their mortgages, leading to a wave of defaults. This triggered a chain reaction where subprime-backed securities started losing value dramatically. What had once been viewed as an intelligent financial innovation was, in fact, a ticking time bomb. The crisis exposed a mystery behind modern finance. How could such a vast network of institutions be so dependent on unstable, poorly understood assets? Systemic risk, which had been more of a theoretical concern, manifested itself in a devastating way. As subprime securities plummeted in value, large banks and financial institutions discovered they were exposed to massive losses. Companies that had made billions in profits began suffering devastating setbacks. The impact of the subprime explosion was so great that many began questioning the intelligence of financial regulators, who had allowed these complex, risky products to proliferate without adequate oversight. Public curiosity about how a system so sophisticated could become so vulnerable dominated discussions among experts and the public. After all, how could so many institutions be affected by what seemed like isolated loan decisions? An iconic example of this collapse was the bankruptcy of Lehman Brothers, one of the world's largest investment banks. With massive exposure to the subprime mortgage market, the bank could not survive the financial storm that had formed. Its bankruptcy in September 2008 was a historic event, sending shockwaves through global markets. This demonstrated, in an extraordinary way, how the collapse of one piece of the system could bring down the whole. The interconnectedness between banks, markets, and countries became evident, revealing the fragility of a system that, until then, seemed immune to risks of this magnitude. The explosion of subprime mortgages also sparked debates about responsibility. Financial institutions had created a labyrinth of complex financial products, often incomprehensible even to professionals within the sector. The lack of transparency and the blind trust in the continuation of a booming market created the perfect environment for disaster. This phenomenon exposed a huge gap in regulation, and public curiosity about who was responsible for the crisis transformed into a search for accountability. From bank executives to government regulators, the subprime crisis revealed that risk, when poorly managed, could spread quickly and unpredictably, affecting not just direct investors but also the global economy. The extraordinary impact of the subprime explosion served as a wake-up call about the need for constant vigilance regarding systemic risk. Public curiosity now centered on how the financial system could be reformed to prevent something like this from happening again. Recovery and regulation efforts were underway, but the path forward was still filled with uncertainty. The fall of banks and global contagion with the collapse of the housing market and the bursting of the subprime bubble. Major banks began to feel the weight of massive losses, leading to a series of bankruptcies that shook the financial world. The most emblematic case was Lehman Brothers, which declared bankruptcy in September 2008, triggering a crisis of confidence in the global banking system. This event was extraordinary because, until then, it was believed that institutions of such magnitude were too big to fail. The fall of a giant like Lehman was a mystery to many, but at the same time, it revealed the hidden fragility at the heart of the financial system. The fear of contagion spread like an uncontrollable phenomenon, affecting banks worldwide. Global contagion started quickly. Other banks, holding vast amounts of subprime mortgage-backed securities, found that their balance sheets were severely compromised. These institutions had once inspired confidence in the market, but panic began to set in. Banks across Europe, Asia, and other regions began suffering significant losses. The interconnected nature of the global financial system became evident as risks, previously seen as isolated to the U.S. housing market, began impacting entire economies. Public curiosity about how the problems of one country could spread so quickly around the world began to dominate discussions among economists and policymakers. As banks around the world began to fail, credit froze. Confidence, one of the most fundamental pillars of the banking system, was destroyed. Institutions that typically lent to one another with ease now found themselves distrustful of any transaction. This freezing of credit had a direct impact on companies, which relied on financing to continue their operations. The banking system's breakdown was a unique and historic experience, and its repercussions were felt at every level of the economy. What was extraordinary was how a problem that began in the U.S. housing sector evolved into a global credit crisis, affecting everything from small businesses to large multinational corporations. In this collapse's context, governments around the world began aggressively intervening to save their economies. The U.S. government, for example, launched the famous TARP, Troubled Asset Relief Program, a multi-billion-dollar bailout package to help stabilize banks. In Europe, similar measures were taken, with central banks injecting trillions of dollars into the system to try to prevent an even larger catastrophe. What was extraordinary was seeing governments worldwide unite in a coordinated effort to rescue the financial system. At the same time, panic was palpable, and public curiosity about what would happen next kept the world in suspense. Global contagion also sparked deep discussions about responsibility. Financial institutions had created a maze of complex financial products that were often incomprehensible even to professionals within the sector. The lack of transparency and blind trust in a booming market created the perfect conditions for disaster. This phenomenon revealed a huge gap in regulation, and public curiosity about who was to blame for the crisis turned into a quest for accountability. From bank executives to government regulators, the fall of banks and the global contagion of the 2007 to 2008 financial crisis taught the world valuable lessons about the danger of taking excessive risks without proper oversight. The financial system was far from the sole culprit in the crisis, but its collapse was a catalyst for a global recession of historic proportions. The extraordinary impact was felt in every corner of the globe, and with it came the realization that modern economies are more vulnerable and interdependent than anyone had ever imagined. This opened the door to discussions and reforms that, if properly implemented, could prevent similar crises in the future. The next step would be dealing with the consequences for the real economy and the lives of ordinary people. The impact on the real economy and rising unemployment as the financial system collapsed, the impact on the real economy was devastating, spreading far beyond banks and investors. The freezing of credit and the collapse of confidence directly affected businesses across all sectors, both large and small. Companies that relied on loans to operate and grow started going bankrupt, and industrial production plummeted. What was extraordinary in this scenario was seeing how a problem that began in the financial sector quickly turned into a global economic crisis, affecting millions of ordinary workers. Rising unemployment was one of the first visible consequences of this phenomenon, as companies downsized operations or shut their doors entirely. Unemployment spread rapidly, deeply affecting families and communities worldwide. In the United States, for example, the unemployment rate jumped from 4.7% in 2007 to 10% in 2009. Millions of workers lost their jobs, and public curiosity about how to rebuild the economy amid such chaos grew. In countries like Spain and Greece, where the impact was especially severe, unemployment reached historic highs. Young people, in particular, were the most affected, with youth unemployment exceeding 40% in some regions. This created a sense of despair and uncertainty. As for many, the crisis meant the end of job opportunities that had once seemed guaranteed. With the drop in demand for goods and services, consumption plummeted, further affecting the real economy. When people lose their jobs, the effect is cascading. They stop spending, fall behind on debts, and companies see their sales drop. It's a vicious cycle where rising unemployment deepens the recession and makes recovery even harder. The extraordinary nature of this cycle showed how modern economies are interdependent and how consumption is essential to keeping the economic engine running. When the foundations of the financial system crumble, the real economy feels the impact mercilessly. Additionally, rising unemployment led to a social crisis, with families struggling to make ends meet. Many lost their homes, unable to keep up with mortgage payments amid the crisis. Public curiosity about how a wealthy and developed country like the U.S. could face such calamity led to intense debate about the government's role in protecting its citizens. In response, social assistance programs were expanded in many countries, but even then, the social safety nets couldn't fully absorb the shock. The extraordinary aspect here was how the financial crisis, seemingly distant from everyday life, directly impacted the well-being of ordinary families, turning into a matter of survival for many. The recession also caused a massive drop in business investment and the development of new technologies and innovations. Companies that, before the crisis, were investing in research and development slashed their budgets, halting important projects. Global economic growth nearly stagnated between 2008 and 2010, and many countries took years to fully recover. This lack of innovation and investment left lasting scars, particularly in sectors like construction, where the housing crisis had a direct impact. The real economy was paralyzed, and public curiosity about how to revive economic growth became a central issue in the years following the crisis. The impact on the real economy also changed how people viewed the labor market. The crisis revealed that many jobs, especially in the service sector and low-skilled positions, were extremely vulnerable to economic shocks. Many workers had to reinvent themselves, seek new skills, and try to adapt to a transforming economy. The crisis made it clear that job stability was an illusion for many, and the extraordinary part was how the crisis accelerated changes in the labor market, with more temporary jobs and fewer long-term guarantees. Finally, rising unemployment and the impact on the real economy left a deep mark on people's confidence in the economic system. Many wondered how the world had reached a point where decisions made by a few on Wall Street had led to the unemployment of millions. The crisis brought a global curiosity about how to reform the economic system, making it more resilient and less susceptible to crises. At the same time, rising economic inequality fueled frustration, as those who suffered most were often the ones who had contributed the least to the crisis. And so, the challenge of rebuilding the economy would be the extraordinary task marking the next phase of this turbulent chapter. Government measures, bailouts, and economic stimulus faced with the severity of the 2007 to 2008 financial crisis, governments worldwide had to act quickly to prevent an even greater economic collapse. One of the first and most influential actions came from the United States, where the government launched the Troubled Asset Relief Program, TARP, which allocated about $700 billion to rescue struggling financial institutions. The extraordinary impact of this measure was clear. Without it, many banks and companies would have failed, deepening the global recession. Public curiosity, however, centered on the morality of bailing out companies that, in many cases, had caused the crisis. Stimulus packages weren't limited to the financial sector. To stimulate the real economy, governments began implementing measures to boost consumption and create jobs. In the United States, the Obama administration introduced the American Recovery and Reinvestment Act in 2009, injecting over $800 billion into infrastructure, healthcare, and sustainable energy. These initiatives aim not only to save banks, but also to ensure that the economy would return to growth. The extraordinary part was the speed with which these actions were implemented. while public curiosity about their long-term effectiveness lingered. Despite these efforts, many citizens questioned whether these packages were enough to truly revitalize the economy. Beyond the United States, other major economies, such as the European Union and China, also took extraordinary measures to contain the crisis. In Europe, the European Central Bank, ECB, lowered interest rates and provided liquidity to banks to avoid a full-scale financial collapse. China, on the other hand, launched a stimulus package worth more than $500 billion to finance infrastructure projects and keep its economy growing despite the global crisis. Public curiosity about how each country would handle the crisis revealed significant differences in economic approaches, but the common goal was the same: to save the global economic system and avoid a new Great Depression. The injection of trillions of dollars into the global financial system by central banks and governments was an extraordinary feat, but it also raised several concerns and controversies. Many wondered if these measures would create a dangerous dependence on government intervention and whether the cost of these bailouts would eventually be passed on to future generations. Public curiosity about the side effects of these policies, such as rising public debt and inflation, began to dominate economic debates. Still, for many, the biggest mystery was how the financial system recovered so quickly while millions of people continued to suffer from unemployment and the housing crisis. Another interesting aspect of these government measures was the growing role of governments in their country's economies. Before the crisis, the prevailing belief was that markets should be left to self-regulate. However, the collapse showed that this approach could have disastrous consequences. Governments had to intervene not only with bailout packages, but also with stricter regulations to prevent future crises. Public curiosity about the state's role in the economy grew, and many began to question the wisdom of leaving markets completely free, especially in such influential sectors as finance. Despite the bailouts and stimulus packages, economic recovery was slow and uneven. Many countries, especially European ones, continued to struggle with extraordinary levels of public debt, exacerbated by bailout spending. Greece, in particular, went through a sovereign debt crisis, requiring multiple rescue packages from the European Union and the International Monetary Fund (IMF). This sparked curiosity about the sustainability of these interventions, with many wondering if the bailouts were merely delaying a new crisis. The domino effect of sovereign debt crises showed that global recovery would be long and full of challenges. Ultimately, post-crisis government measures left a mixed legacy. On the one hand, they prevented a total financial collapse, saving banks and stabilizing the financial system. On the other hand, the consequences of these measures, such as increasing economic inequality and growing public debt, are still felt in many countries. The extraordinary part is how these decisions shape the future of the global economy, placing the government at the center of managing financial crises. Public curiosity about what could have been done differently continues to be a hot topic of debate among economists, politicians, and the general public, especially as new crises loom on the horizon. Economic recovery. Challenges and lessons learned. Economic recovery after the 2007 to 2008 financial crisis was a long and challenging process that offered important lessons for the future. After the markets collapsed and governments intervened, the global economy began to show signs of recovery, but in an uneven manner. While some countries, like the United States and Germany, managed to bounce back more quickly, others, especially in Europe, struggled for years with the effects of the crisis. The extraordinary aspect here was the resilience of some economies, while public curiosity about why others couldn't match the same pace of recovery opened up reflections on the factors that determine economic recovery in times of crisis. One of the main challenges in recovery was balancing economic stimulus with the need to reduce public debt. Countries like the U.S. injected trillions into stimulus packages, but also had to deal with rising national debt. Public curiosity about how to balance these two forces, stimulating the economy without overburdening public finances, became a central question for economists. In European countries, where sovereign debt crises were more acute, austerity became the recovery strategy, but with mixed results. In countries like Greece, public spending cuts and tax increases deepened the recession and led to popular protests, raising questions about the effectiveness of these policies. Another major challenge was restoring trust in the financial system. Banks and financial institutions suffered a major blow to their credibility during the crisis, and recovery required significant reforms. Financial regulation intensified, with new standards of transparency and stricter controls to prevent future crises. What was extraordinary was how the financial sector adapted to these changes without losing its global influence. Reforms like the Dodd-Frank Act in the U.S. were implemented to increase the system's resilience, but public curiosity persisted. Were these measures enough to prevent another crisis, or did they merely ease the risks temporarily? Recovery was accompanied by a sense of caution about the future of the banking sector. The crisis also revealed the importance of diversifying sources of economic growth. Many economies that relied heavily on specific sectors, like real estate or finance, felt the crisis effects more intensely. Public curiosity about how to create a more balanced and resilient economy began to grow. A prime example of this was China, which shifted its focus to innovation and technology, seeking to diversify its growth beyond its dependence on infrastructure investments and exports. Long-term recovery required countries to rethink their development strategies, with a focus on innovation and sustainability. This was a fundamental learning point for economies looking to avoid future dangerous dependencies. Another important aspect of the economic recovery was the social response to the crisis. Rising inequality became a central theme, as many of the benefits of the recovery were concentrated among the upper classes and large corporations. Workers who had lost their jobs or homes during the crisis were the slowest to recover, and in many cases, they never fully regained the standard of living they had before. Public curiosity about how to create a more inclusive recovery that benefits everyone became a priority for many countries. Social and political movements began to gain momentum, calling for economic reforms that address the inequalities generated by the crisis. Economic recovery also showed the importance of international cooperation. What was extraordinary was seeing how, in a globalized world, one country's recovery depended largely on the policies adopted in others. The G20 and other multilateral organizations played key roles in coordinating economic and financial policies to ensure a more balanced recovery. However, public curiosity about the role of global institutions and the effectiveness of international cooperation remained a subject of debate. Recovery also revealed the vulnerabilities of a highly interconnected financial system and the need for greater vigilance and cooperation to prevent future crises. Finally, post-2007-2008 recovery efforts left valuable lessons about the importance of crisis preparedness and planning. Governments and financial institutions around the world began to build larger reserves and develop rapid response policies to deal with future crises, seeking greater resilience. The extraordinary impact of this crisis forced the world to rethink how it manages risks and prepares its economies for shocks. Yet, despite the lessons learned, public curiosity about how the world will deal with the next major economic crisis remains alive. After all, history has shown that while we may learn from the past, new challenges always arise in the future. The role of central banks in economic stabilization during the 2007 to 2008 financial crisis, central banks played a crucial role in stabilizing global economies. Faced with the collapse of financial markets, these institutions had to act in extraordinary and innovative ways to prevent a larger catastrophe. The U.S. Federal Reserve, led by Ben Bernanke, was one of the first institutions to take aggressive steps to contain financial panic. Reducing interest rates to historically low levels was one of the first actions, aiming to stimulate the economy and ease access to credit. What was extraordinary here was how these seemingly simple measures would have such a profound impact on such a complex system. In addition to lowering interest rates, central banks turned to a less conventional but highly influential tool, quantitative easing QE. This strategy involves central banks buying large quantities of financial assets, such as government bonds and mortgage-backed securities. The goal was to inject liquidity into the financial system and encourage investment. Public curiosity about how this phenomenon would affect the economy in the long run grew, as this was an extraordinary approach that had never been used on such a scale. The measure helped stabilize markets, but also raised questions about potential side effects, like the creation of new asset bubbles. In Europe, the European Central Bank, ECB, also played a crucial role in stabilizing the Eurozone. Under the leadership of Mario Draghi, the ECB took bold steps to prevent the collapse of the single currency, as several European countries, such as Greece, Portugal, and Ireland, faced sovereign debt crises. The phrase, "whatever it takes," spoken by Draghi in 2012, marked the ECB's commitment to saving the euro by using extraordinary measures, such as the mass purchase of public debt from the most affected countries. Public curiosity about how this massive intervention would alter Europe's economic dynamics took hold, and the effects of these actions are still debated today. The role of central banks in the crisis also revealed the importance of global coordination. On several occasions, central banks worldwide acted together to provide liquidity and ease tensions in international financial markets. The Federal Reserve, the ECB, the Bank of England, and the Bank of Japan coordinated their monetary policies, showing that in a globalized economy, joint action is essential to deal with crises. This phenomenon of international cooperation was extraordinary, as it showed that the interdependence of economies required a global response. However, public curiosity about the limits of this coordination persisted, as each economy has its own particularities and challenges. One of the major questions that emerged throughout the crisis was the independence of central banks. While the decisive actions of central banks were widely praised, some critics began to question to what extent these institutions were acting autonomously or under political influence. The pressure to save large banks and prevent the collapse of the financial system sparked public curiosity about the role of governments in central bank decisions. The independence of central banks is seen as crucial to maintaining market confidence, but the crisis showed that, in times of turmoil, the lines between monetary and fiscal policy can blur. Another important point in the actions of central banks was communication. During the crisis, market expectations became a critical factor, and central banks needed to adjust how they communicated their policies to the public and investors. Terms like forward guidance became prominent, referring to the practice of central banks providing clear guidance on future interest rates and other monetary policies. This was an important innovation to avoid panic and help guide economic expectations. Public curiosity about how clearer communication could have prevented the escalation of previous crises grew, as by providing more transparency, central banks helped stabilize markets that were on the brink of chaos. Finally, the role of central banks in economic stabilization provided an important lesson. Flexibility and the ability to adapt are crucial in times of crisis. The extraordinary measures adopted, from low interest rates to quantitative easing, showed that central banks cannot be rigid in their policies. They need to be able to respond to unexpected phenomena with innovative solutions. However, public curiosity about the long-term impacts of these actions continues to fuel debates among economists. Have these policies created new vulnerabilities for the future? The role of central banks in global recovery was undeniable, but the path to ensuring a stable and resilient economy is far from fully understood. The crisis of confidence in the financial system, the 2007 to 2008 financial crisis, triggered one of the largest crises of confidence in the global financial system. For years, the banking sector had been seen as the backbone of modern economies, and many believed that major institutions were safe and stable. However, with the collapse of giants like Lehman Brothers and the exposure of mistakes made by financial institutions worldwide, trust in the financial system was deeply shaken. What was extraordinary was how this crisis, initially limited to the housing market and subprime mortgages, transformed into a global phenomenon that shook faith in institutions once considered unshakable. Widespread distrust began to spread rapidly. Investors, companies, and even governments started questioning the financial health of banks, and the fear that other large institutions might fail set in. As a result, Many people began pulling their money out of banks and selling assets, creating a domino effect that fueled even more panic in the markets. Public curiosity about how so many financial institutions could have ignored the risks and maintained an appearance of solidity grew, revealing that the real mystery wasn't just a collapse, but how so many management and regulatory failures went unnoticed for so long. The general public's distrust of the financial system also affected the relationship between banks and ordinary people. The perception that major banks were responsible for the crisis sparked widespread outrage, with protests erupting in various parts of the world. Movements like Occupy Wall Street emerged in response to the feeling that the financial system had become corrupt and uncontrolled, serving only the wealthy and powerful. This distrust wasn't just economic but also moral, raising questions about the ethics and social responsibility of financial institutions. What was extraordinary was that, for the first time in decades, the public began demanding deep changes in the global financial system. In addition to public distrust, the crisis exposed internal vulnerabilities in the banking system itself. Many banks, which had previously trusted one another for short-term loans, suddenly became reluctant to lend. The freezing of interbank credit worsened the crisis even further, as banks didn't know which institutions were exposed to toxic assets. Public curiosity about how a system so interconnected and dependent on mutual trust could crumble so quickly sparked discussions among economists and financial analysts. This structural fragility showed that trust, although intangible, was an extraordinarily powerful force in the system's functioning. Governments and regulators were forced to intervene in extraordinary ways to restore trust in the financial system. Bailout packages, such as TARP in the United States and the European Central Bank's interventions, were crucial to preventing the total collapse of economies. However, these bailouts also raised questions about how far governments should go in saving private companies, especially those that had contributed to the crisis. Public curiosity about who would be held accountable for the crisis and who would pay the price became a constant theme in the years that followed. The feeling that the system was being saved at taxpayers' expense only deepened resentment and distrust. The crisis of confidence also led to a series of regulatory reforms designed to restore stability and transparency in the financial system. Laws like Dodd-Frank in the United States introduced new oversight mechanisms to prevent the kinds of practices that had led to the crisis. What was extraordinary was the speed with which the regulatory system was reorganized to try to contain systemic risk. However, public curiosity about the effectiveness of these reforms continued, with many questioning whether they would be enough to prevent another similar crisis in the future. After all, the financial system is notoriously adaptable and often finds new ways to bypass regulations. Finally, the crisis of confidence in the financial system had a lasting impact on public attitudes toward banks and financial institutions. Even years after the crisis, trust in the sector remained shaken. Public curiosity about whether the financial system had truly learned the lessons of the crisis persisted, with many fearing that the same risky practices could reemerge. This crisis of confidence also led to a cultural shift within the sector, with a greater emphasis on corporate governance, social responsibility, and transparency. However, the extraordinary legacy of the crisis is that, even with all the changes, the financial system continues to be seen by many as a realm of uncertainty and high risk. Restoring full confidence in the global financial system is a process that is still ongoing. The wounds left by the crisis were deep, and rebuilding that trust requires not only regulatory reforms, but also a change in the mentality of financial institutions. Public curiosity about the future of the system remains alive, as the world watches to see whether these lessons will truly transform into a more solid and resilient structure. The impact on global markets and emerging economies. The financial crisis of 2007 to 2008 was not limited to developed countries. Its impacts quickly spread to global markets, also affecting emerging economies. As banks collapsed and credit tightened in the United States and Europe, the interconnectedness of the global financial system became clear. Economies that had previously seemed distant from the crisis were severely affected by the drop in demand for exports and the collapse in commodity prices. The domino effect was extraordinary, revealing how deeply integrated global markets had become. Public curiosity about how distant economies could suffer so much from a crisis originating in the West began to take shape, highlighting the structural vulnerabilities of developing countries. Emerging economies such as Brazil, Russia, India, and China, the BRICS, were experiencing rapid growth before the crisis, fueled by large volumes of foreign investment and export-driven expansions. However, with the financial collapse, these capital flows reversed quickly. International investors, in search of safety, began pulling their money out of emerging markets and moving it into safer assets like U.S. government bonds. What was extraordinary was how this sudden capital outflow led to a liquidity crisis in these countries, affecting their currencies and putting pressure on their financial markets. Public curiosity about how these economies, once seen as unstoppable, began to falter, underscored the fragility of the global financial system. The impact was especially felt in countries dependent on commodity exports, like Brazil and Russia. The decline in global demand and in the prices of products like oil, iron ore, and soybeans hit these nations hard, as they saw their revenues and economic growth slow. The crisis revealed the excessive dependence of these economies on international trade and commodity price volatility. Public curiosity about how these countries could diversify their economies and better protect themselves from global shocks became a central issue for leaders and economists. The extraordinary challenge was finding ways to build economic resilience in an increasingly interdependent world. China, on the other hand, took an innovative approach to deal with the crisis effects. The Chinese government launched a massive economic stimulus package, investing in infrastructure and domestic development projects. This not only helped China maintain growth, but also served as a driver for global recovery by sustaining demand for commodities from other emerging countries. What was extraordinary was the speed and effectiveness with which China managed to mitigate the crisis effects, while other economies struggled to stabilize. Public curiosity about how China's government-driven growth model could be replicated elsewhere began to emerge, though with considerable challenges. On the other hand, the crisis had a significant impact on the most vulnerable emerging economies, which were already facing structural challenges like high levels of external debt and fiscal deficits. Countries like Argentina and Venezuela were further weakened by the credit crunch and export collapse. Public curiosity about how these countries, already fragile before the crisis, could avoid total collapse became a pressing issue for the international community. What was extraordinary was how these nations came to depend on external assistance, such as loans from the International Monetary Fund (IMF), to avoid complete economic catastrophe. The crisis also sparked a debate on the need for a new global financial architecture. Many economists and political leaders argued that the international financial system, dominated by institutions like the IMF and the World Bank, was not prepared to handle crises of this magnitude. Public curiosity about how to reform these institutions to respond more effectively to global crises grew. Emerging countries began pushing for greater representation in these organizations, given the disproportionate impact the crisis had on their economies. This movement culminated years later with the creation of new financial cooperation mechanisms, such as the BRCS-led New Development Bank. Finally, the recovery of emerging economies was uneven and, in many cases, slow. While some countries managed to stabilize with stimulus packages and adjustment policies, others remained in crisis for years. The extraordinary legacy of the crisis for these countries was the realization that, in a globalized world, no economy is completely immune to external shocks. Public curiosity about how these nations can better prepare for future crises remains, as the world watches to see whether the lessons learned during the 2007 to 2008 crisis will be enough to prevent new global financial collapses. The legacies of the crisis. Changes in global economic and financial policies. The 2007 to 2008 financial crisis left a deep and lasting legacy on global economic and financial policies, forcing governments, central banks, and international institutions to rethink their approaches. One of the main changes was the recognition of the need for stricter regulation in the financial sector. In the years leading up to the crisis, The financial system was operating with extraordinary freedom, with little oversight over risky practices like subprime lending and the creation of highly complex financial products. The crisis brought to light the urgency of reforming the rules of the game to prevent such phenomena from happening again. Public curiosity about how these regulatory changes could prevent future crises became a central issue for economists and policymakers. In the United States, the Dodd-Frank Act, passed in 2010, was a direct response to the crisis. It aimed to increase transparency in the financial sector by imposing stricter requirements on large banks and financial institutions. The creation of the Consumer Financial Protection Bureau, CFPB, was also an extraordinary innovation designed to protect consumers from predatory practices that had contributed to the housing market collapse. Public curiosity about the long-term effects of these new regulations persisted, as many wondered whether these measures would be enough to prevent a similar crisis. Still, the impact was clear. Confidence in the financial system needed to be restored, and this could only be done through clearer rules and greater oversight. Beyond national reforms, the crisis also prompted changes at the global level. The G20, a forum that brings together the world's largest economies, took on a central role in coordinating international economic policies after the crisis. Public curiosity about how a coordinated global response could improve economies' resilience gained prominence. At regular meetings, the leaders of the world's major economies discuss ways to strengthen the financial system, promote sustainable growth, and avoid repeating the mistakes that led to the crisis. What was extraordinary was seeing how, in the face of such a grave crisis, nations were forced to cooperate, setting aside historical differences for the sake of a common goal. Another significant legacy of the crisis was the role of central banks. Monetary policy became even more crucial in stabilizing economies. The Federal Reserve, the European Central Bank, and other major central banks adopted extraordinary monetary policies like quantitative easing, QE, to inject liquidity into markets and keep economies afloat. Public curiosity about how these measures, once seen as temporary solutions, would affect the future of global economies grew. The impact of these expansionary policies was a slow but steady recovery. However, concerns about the side effects, such as rising public debt and asset bubbles, fueled debates about the limits of these interventions. The crisis also highlighted the need for a reassessment of fiscal policies. Many countries face a dilemma between adopting austerity policies to control public debt or continuing fiscal stimulus to avoid economic collapse. What was extraordinary was the difference in approaches between countries. In Europe, austerity became the dominant strategy in countries like Greece and Spain, leading to prolonged recessions and high unemployment rates. In the United States, the government chose to maintain stimulus packages, which helped the economy recover more quickly. Public curiosity about which approach would be most effective still generates debates among economists and policymakers, with each side defending its strategies based on post-crisis outcomes. The crisis also catalyzed a movement toward greater corporate responsibility and governance. Companies, especially large financial corporations, were pressured to adopt more transparent and ethical practices. The extraordinary impact of corporate governance failures during the crisis, such as the lack of internal controls in many financial institutions, led to greater scrutiny from shareholders and regulators. Public curiosity about how companies could balance the pursuit of profit with social responsibility intensified. This shift was crucial for the development of a new kind of capitalism, where sustainability and social impact took on greater weight. Finally, one of the most lasting legacies of the financial crisis was the awareness of the importance of being prepared for future crises. Governments and financial institutions worldwide began to build larger reserves and develop rapid response policies to deal with future crises, seeking greater resilience. What was extraordinary was the recognition that, in a globalized world, financial crises do not respect borders and can spread quickly, making preparedness a global priority. Public curiosity about how to avoid future crises led to the development of early warning mechanisms and greater international cooperation in financial regulation. However, the real mystery was whether these lessons would be enough to prevent new collapses in the future. The legacy of the 2007 to 2008 financial crisis profoundly transformed the way global economic and financial policies are formulated. The lessons learned from the mistakes and excesses of the past helped shape a system more aware of risks and better prepared to deal with future turbulence. However, public curiosity about what the future holds remains, as the world watches to see if these changes will be enough to prevent new economic meltdowns on the global horizon. The 2007 to 2008 financial crisis taught us powerful lessons that cannot be ignored. The global financial system is more vulnerable than it appears, and the responsibility for maintaining it rests on everyone's shoulders: governments, institutions, and individuals. Are you prepared for the next crisis? Have you thought about the impact your financial decisions could have in the long run? These questions are more urgent than ever. Subscribe to the channel and turn on notifications to keep learning how to navigate the complex world of finance and make smarter decisions in the future.